Hey, welcome to Losing Money with Ken. Today's topic is inflation and how we can invest in a prolonged period of inflation. So in the newspaper headline today, it says inflation in Singapore continues to rise, surpasses October highs. So let's take a look at the article proper and see if we have any clues on what three sectors we can actually invest in. Yeah. Okay, it says prices driven up by higher domestic demands for goods and services and rising import costs. So we can actually get some important clues here what is actually happening in our economy. Prices driven up, higher demand for goods and services, and of course rising import costs. So all these three are signs that the economy is heating up. But just how hot it is, we shall see. So let's take a look at the main article. It says that prices in Singapore are rising more sharply than expected, and with inflation highest in several years. So we can now see people start complaining about how things are getting more and more expensive. So the good news is that there's greater domestic demand. So in this case, it will be a case where we have more cash chasing limited amounts of goods and services. And it says on the flip side, the prices are driven up by rising import costs amid the global transportation bottlenecks. Okay, this has been ongoing for a few months already, years, 1 year plus, 1.5 years, where the supply chain has been globally disrupted by COVID. So that's not something new. But now the issue is happening is that when the economy is heating up and it met up with transportation bottleneck, it will actually push up the prices higher because the goods are not reaching the market fast enough for money to consume them. So it leads to more money chasing less goods. So anyway, let's continue through the article. It says that we're recovering, the prices are starting to rise after a spell that caused them to fall amid plunging during the pandemic. Okay, so again, this paragraph is stating that we are recovering. So could it be just a mirage in the desert, an oasis mirage? We don't know, so we shall see. But now the keyword is inflation. And of course, it says that wages have increased and are expected to continue rising. Well, it's probably because of the tight labor market due to the control of movement of people across borders. So that will actually cause hiring issues and a tighter labor market. Yeah, COVID did what we can't do, raise our salary. And of course it says, okay, nothing important here. Let me just scan through it. Bloop, 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 bloop. Scanning. Bloop, bloop, bloop. 8 years high. Bloop, bloop, bloop. Bloop, bloop, bloop. Okay, sharp rise in private transportation costs. And private transport inflation rose 17%. So we've been seeing back-to-back double digits increase November and October, whereas you can see the other are just going at single digits. And we have one big case that goes double digit, which is private transportation, meaning car prices. So we can see that car prices are going up for the past 2-3 months, 4 months. So yeah, that's probably leading to a big jump here. So next thing we can see, this is more critical because not everybody wants to get a car, but electricity and gas prices, they have a deeper cascading effect because everybody uses electricity and gas. So this one will cascade through the economy. So an increase here will probably create a feedback loop that's actually causing further inflation down the road. Okay, service inflation also single digit, insignificant. And we're at the final column. Nothing spectacular, and we just take a look at what is actually falling. So it says retail and other group goods fell more sharply, 0.9%. So this is one sector to avoid, retail. And it says that this is more for COE. So from this article, we can actually derive three kind of sectors that will actually benefit from inflation. So traditionally, when we see a period of inflation, it actually means that the banks will actually try to rise their interest rates. Well, central banks, but Singapore we don't have this, but generally we follow the US interest rates. So one thing we should see coming up very soon will be the increase in interest rates. And when interest rate increases, the number one beneficiary would be the financial industry. So imagine that if you have a $100,000 loans going out at 1%, and just imagine that for that same loan, the 100,000 loan is now going out at 5%. So that would be a difference of between $1,000 and $5,000. So that would be $4,000 difference in the interest itself. So imagine who pockets this interest gains. Yep, it will be the banks. So the next sector we can take a look at is actually the energy industry. As we can see in this part, electricity and gas costs, no matter how much they rise, that rise will be passed on to the consumer and will cascade through. But as with any provider, the higher price they sell it, the more profit they can take. So that's one sector we can take a look about also to take note of. And of course, at the end of the day in Singapore, a third sector that would probably be quite nice for dividends would be the transport sector. Where would that be? The transport sector. Yep. So I'm not saying about private transport, I'm talking about public transport, because due to the rising cost of gas, which also means petrol, fuel prices, and higher inflation, and the bus and MRT operators will be allowed to increase the fares, that it will also indirectly increase their income more than what the inflation of the fuel prices or general inflation has caused to them. And yep, so these are the three sectors. Financial sector, namely banks. Secondly, energy sector, companies that are providing energy works, blah blah blah, maintenance, etc. Energy trading, etc. And of course, thirdly is public transportation, and I think they will be able to pass on any costs arising from higher prices due to inflation or just petrol prices or diesel prices, whatever. So it doesn't really matter for them, and they'll still be able to give a dividend. Okay, I guess that's for today. Bye.